Chris, what's your reaction to this headline number?
Thanks so much for having me. This number is a little bit lower than it was a month prior and a little bit lower than what was forecast, but this is still in an expansionary territory. The strong spending in services is a continuation of a theme that we've seen with the headline being in expansionary territory pretty consistently since the end of the pandemic. This mirrors the economy overall, with spending concentrated on services, and the consumer still going pretty strong. Despite this continued strength, though, we are seeing softness in pockets, especially among those at the lower end of the income segment. In aggregate, consumer balance sheets are pretty strong, but there is some underlying weakness there, and spending is being driven by a narrowing segment of the population. We don't see spending falling off a cliff by any means, but we do think that we're going to see a bit of a slowdown from the observed strength of the past few quarters as wage growth stagnates and savings are run down. You are right to point out, though, the higher print for the prices paid. That should be a little bit concerning to the Fed, because that does confirm a theme that we've seen over the past few months of progress on inflation stagnating a bit.
Yeah, Chris, I'm curious, how big of a risk do you see the upside threat here of inflation heading into the new year?
I don't see much of a risk of inflation reaccelerating back up to 3%, but I do think that there's a significant risk that inflation plateaus at a level uncomfortably above target for the Fed. This has been expressed in some of the Fed speak that we've seen over the past few months, and we do think that the Fed is still on track to cut at the December meeting. But we think it's going to be a hawkish cut. We think Powell is going to signal that the tempo of cuts in 2025 is going to slow a little bit, and indeed we think that the Fed is going to skip in January and then start with a quarterly cutting cadence in 2025.
Chris, what's the level, and I know it's tough to determine at this point, but what is the level for inflation that you think is going to keep the Fed potentially bent on the sidelines?
I think if it keeps rounding up to 3, the Fed's going to be uncomfortable with that. And there's a lot of X factors out there, most notably, not one that the Fed's going to mention explicitly, but the policies from Trump. They're broadly reflationary, as stated by the president-elect. And I think that's one of the reasons why it will be prudent for the Fed to skip the January meeting. Trump says he's going to do a lot of things on day one, and there are a lot of things that he has the power to do on day one. Tariffs are one, curbing inflation is another. Both of those things have the potential to be inflationary, and we think it'd be prudent for the Fed to skip in January, assess what Trump does in his first few weeks in office, and then reassess the economic backdrop in March.
How much clarity are you expecting to get from Jay Powell about the path forward today? He is expected to speak. It'll be his last chance to speak prior to that December meeting.
He's struck a very similar tone in the past few months, both at Fed meetings and in other fora as well. So we don't expect a really big change from that perspective. He's going to harp on the Fed being data dependent. He's going to say that the Fed is still going to be vigilant against inflation, but fairly optimistic about the economic backdrop overall. We've got a labor market that's about in equilibrium. We don't see much of an inflationary impulse there. The biggest risk, as I said before, is that inflation continues to hover in that 2.5, 2.6 range. That's uncomfortably high for the Fed.
Well, it's interesting, too, because we've been hearing a little bit of a conflicted message from other Fed members, not necessarily voting members, but this morning, the Federal Reserve Bank president of St. Louis talking about how he sees a greater risk of easing policy too much too soon. Do you take that to heart much in your outlook for the broader voting members of the Fed?
Absolutely. Absolutely. And we have to look at the shift of the composition of the voters come 2025 as well. I think there is a pretty vigorous internal debate at the Fed right now, what the R star is, what the short run R star is, and what the long run R star is. And as long as we have fiscal policy and budget deficits that are running at about 6.5%, and probably going to go up as of 2026 if the Tax Cuts and Jobs Act gets extended and expanded as we think that it will, then the Fed's going to have to reassess what that short run R star is. We're going to get the summary of economic projections at the December meeting. The central tendency of the long run policy rate for the Fed has continuously gone up over about the past year and a half. And we think it's going to reach about 3% and continue an upward path. So I do think that this is a vigorous conversation that's going on behind closed doors right now at the Fed.